In 2023, the average new car transaction price in America hit $48,000 according to Kelley Blue Book data. But that sticker price tells only part of the story. When you factor in the full cost of financing, insurance, negative equity from trade-ins, and dealer add-ons, Americans are routinely spending $80,000 to $100,000 or more on vehicles over the life of their loans. The twist? After years of payments, many owners have built almost no equity. Some owe more than their cars are worth. This is the math that dealers don't advertise. This investigation traces how a single car purchase can balloon from a $50,000 vehicle into a six-figure financial commitment. We'll examine the lending structures, the dealer incentives, the insurance products, and the depreciation curves that create a system where monthly payments never stop but equity never builds. Every number cited comes from industry reports, federal data, or documented dealer practices. The goal is simple: understand how Americans can pay for a car multiple times over and still not own it. According to Experian State of the Automotive Finance Market reports, the average new car loan term reached 68 months in 2023. But that average masks a darker trend. Loans of 72 and 84 months now represent over 35% of all new vehicle financing. A decade ago, 84-month loans were rare. Today, they're standard offerings at most dealerships. J.D. Power data shows some lenders now offering terms up to 96 months, 8 full years. These extended terms exist for one reason: to lower the monthly payment enough to make expensive vehicles appear affordable. Federal Reserve data from 2023 shows the average auto loan interest rate for new cars reached 7.2% for borrowers with good credit. For those with fair or poor credit scores, rates climbed to 11% or higher according to Edmunds Finance Tracking. On an 84-month loan, even a seemingly modest 7.2% rate means paying thousands in interest. On a $50,000 vehicle, total interest over 7 years exceeds $13,000. For subprime borrowers at 11%, that same loan generates over $21,000 in interest payments, nearly half the original vehicle price paid purely to the lender. Consumer Reports research shows that 73% of car buyers focus primarily on monthly payment rather than total vehicle cost or loan terms. Dealers know this. A $60,000 SUV becomes only $699 per month when stretched to 84 months, which sounds more manageable than discussing the $70,000 plus total cost after interest. The monthly payment metric hides the true expense. It also creates an opening for dealers to sell additional products and services, extended warranties, gap insurance, paint protection, by adding just $30 more per month. Those small additions compound into thousands in total cost. Edmunds reports that in 2023, nearly 25% of trade-in vehicles carried negative equity. The owner owed more than the car was worth. The average negative equity amount reached $6,000 per vehicle according to their Q3 data. When dealers accept these trade-ins, that negative balance doesn't disappear. It gets rolled into the new loan. A buyer trading in a car with $8,000 in negative equity on a new $50,000 vehicle is actually financing $58,000 before taxes, fees, and add-ons. They start the new loan already underwater, owing more than the new car's market value from day one. The negative equity problem compounds with each trade cycle. Cox Automotive Analysis found that some consumers are rolling over negative equity 2 or 3 times consecutively, creating debt pyramids. A buyer might trade in a car with $5,000 in negative equity, drive the new vehicle for 3 years while it depreciates faster than the loan balance declines, then trade again with $8,000 in negative equity. After multiple cycles, borrowers can owe $15,000 to $20,000 more than their current vehicle's worth. The debt accumulates across vehicles, completely detached from any single car's actual value. Carfax and Black Book data show new vehicles lose approximately 20% of their value in the first year and around 60% over 5 years. But loan amortization, the pace at which you pay down principal, doesn't match that curve. On extended loans, early payments go primarily to interest. According to Bankrate's auto loan calculators, on an 84-month loan at 7%, you'll pay down only about 15% of the principal in the first 2 years while the vehicle loses 30% of its value. The loan balance stays high while market value plummets, creating structural negative equity built into the financing itself. Consumer Reports investigations reveal that dealership finance offices routinely sell add-on products that generate 50 to 80% profit margins. Extended warranties can cost $2,000 to $4,000 but pay out claims worth far less according to analyst estimates. Gap insurance, which covers the difference between loan balance and vehicle value if the car is totaled, typically costs $500 to $700 through dealers but only $20 to $30 per year through regular auto insurers. Paint protection, fabric treatments, and VIN etching add another $1,000 to $2,000 combined. These products are financed into the loan, so buyers pay interest on them for years. When these add-ons get rolled into an 84-month loan at 7.2% interest, the total cost balloons. A $3,000 extended warranty financed over 7 years doesn't cost $3,000, it costs approximately $3,800 after interest. That $700 dealer gap insurance becomes nearly $900 all in. The paint protection package advertised at $1,200 ends up costing $1,500. According to the Center for Responsible Lending, the average car buyer who finances add-ons pays 25 to 30% more than the sticker price of those products due to interest accumulation. The dealer gets paid up front, the buyer pays the premium over years. Let's examine a real-world scenario using industry-standard numbers. A buyer finances a $50,000 vehicle at 7.2% for 84 months with $5,000 in rolled negative equity and $3,000 in add-ons. Total financed, $58,000. After 3 years of $700 monthly payments, they've paid $25,200 total. But according to standard amortization, only about $16,000 went to principal, the rest was interest. Their loan balance is approximately $42,000. Meanwhile, Black Book data shows the vehicle's market value dropped to around $30,000. They're $12,000 underwater after 3 years and $25,000 in payments. Full coverage insurance on a financed vehicle is mandatory, and Bankrate's 2023 rate survey found the average annual cost reached $2,014 nationwide. In states like Michigan and Louisiana, averages exceeded $3,000 per year. Over an 84-month loan, that's $14,000 to $21,000 in insurance premiums that must be factored into total ownership cost. Unlike the loan payment, insurance doesn't build equity, it's pure expense. For younger drivers or those with imperfect records, annual premiums can hit $4,000 to $6,000, adding another $28,000 to $42,000 to the total 7-year cost of vehicle ownership. Now we can calculate the complete financial picture. Start with a $50,000 vehicle. Add $5,000 rolled negative equity from the trade-in. Include $3,000 in dealer add-ons. That's $58,000 financed at 7.2% for 84 months, generating approximately $13,500 in interest. Subtotal, $71,500 in loan payments. Add 7 years of insurance at $2,000 annually, $14,000. We're at $85,500 before considering maintenance, fuel, registration, or taxes. A buyer could easily surpass $100,000 in total outlays. And according to our equity analysis, after 3 years they still owe more than the car is worth. They don't own the vehicle, they're renting it from the bank. The structure of modern auto financing creates clear winners. Lenders earn billions in interest. The Consumer Financial Protection Bureau reported auto loan interest revenue exceeded $120 billion annually in recent years. Dealers profit from finance reserve, the markup between the buy rate from lenders and the rate sold to customers, plus lucrative add-on commissions. According to NADA data, dealership finance and insurance departments generate higher profit margins than vehicle sales themselves. Extended loan terms maximize interest revenue. Negative equity rollovers increase loan amounts. Add-ons boost dealer profit. The system is optimized for revenue extraction, not consumer equity building. For borrowers with credit scores below 620, the numbers grow more severe. Experian data shows subprime auto loan rates averaged 11.5% in 2023, with deep subprime exceeding 14%. On a $50,000 vehicle financed at 14% for 84 months, total interest approaches $27,000. Monthly payments reach $850 or more. According to the New York Federal Reserve, auto loan delinquency rates for subprime borrowers exceeded 7% in late 2023, the highest level in over a decade. These borrowers pay the most, build equity the slowest, and face the greatest risk of default and repossession, often losing thousands in payments with nothing to show. Industry research from Cox Automotive shows the average consumer trades or sells their vehicle every 6 years. But with 84-month loans, 6 years means you still have 12 payments remaining. If you're underwater, which our analysis shows is likely, you face a choice: pay the difference in cash to clear the loan, or roll the negative equity into the next purchase. Most choose the rollover. The Urban Institute found that repeat auto buyers frequently carry forward debt from previous vehicles, creating a cycle where they're perpetually financing more than the current car's value. Each trade resets the clock but increases the burden. Some argue leasing avoids these equity problems. Edmunds' analysis shows typical lease terms run 36 months with lower monthly payments, perhaps $400 to $500 versus $700 for a purchase loan on the same vehicle. But lessees build zero equity, face mileage restrictions typically around 12,000 miles annually, and pay penalties for excess wear. After 3 years, they own nothing and must start over. Consumer Reports notes that perpetual leasing can cost more long-term than purchasing and holding. However, lessees avoid negative equity traps and depreciation risk. It's a different calculation: guaranteed zero equity versus potential negative equity. IHS Markit vehicle data reveals that while average vehicle age on the road increased to over 12 years, consumers financed through dealerships trade much sooner. The pressure to trade comes from multiple sources: manufacturers advertise new features and safety technology, dealers contact customers mid-loan with trade offers, and vehicles approaching 60,000 to 70,000 miles trigger warranty concerns. Automotive News reports dealers actively market to customers with 3 to 4 years remaining on their loans, promising lower payments through refinancing or new purchases. These offers rarely mention that trading resets negative equity and extends the debt cycle indefinitely. The existence of gap insurance as a major dealer product reveals the industry's awareness of structural negative equity. Gap insurance covers the difference between what you owe and what the vehicle is worth if it's totaled. According to Investopedia, dealers charge $500 to $700 for gap coverage that costs them under $100 to provide, or that consumers could purchase through their regular auto insurer for $3 to $5 per month. The product is profitable because the underlying problem, loans that exceed vehicle value, is common and predictable. The fact that gap insurance is routinely offered suggests dealers know buyers will be underwater. They're selling the solution to a problem they helped create. The Consumer Financial Protection Bureau has examined auto lending practices, issuing guidance on discriminatory markup and add-on products. Several states implemented maximum loan term restrictions. California considered capping auto loans at 60 months for certain lenders. But federal regulation remains limited. The Truth in Lending Act requires disclosure of APR and total payments, but research from the Brookings Institution shows consumers struggle to process these disclosures when presented in dense contracts during high-pressure dealership closing processes. The National Consumer Law Center has advocated for stricter lending standards and add-on regulations, but industry lobbying has largely prevented comprehensive reform at the federal level. COVID-19 supply chain disruptions created a temporary anomaly. Used car prices spiked dramatically in 2021 to 2022. Manheim Used Vehicle Value Index showed increases exceeding 40% at the peak. For the first time in decades, some owners had positive equity even on relatively new loans. According to Edmunds, trade-in values exceeded loan balances for many consumers during this period. But this was an aberration, not a new normal. As supply chains recovered through 2023, used car prices declined and traditional depreciation patterns resumed. The brief equity window closed, and the structural problems of extended loans and negative equity returned. The shift toward electric vehicles introduces new dynamics. Kelley Blue Book data shows average EV transaction prices exceeded $61,000 in 2023, significantly higher than gas vehicle averages. Federal and state incentives can reduce effective cost by $7,500 to $12,500, but these often apply as tax credits rather than point-of-sale reductions, meaning buyers still finance the full amount. Cox Automotive reports average EV loan terms mirror or exceed gas vehicle terms, many at 72 to 84 months. Early depreciation on EVs has proven severe for some models as technology rapidly evolves and new competitors enter the market, creating potential negative equity scenarios even worse than traditional vehicles. Federal Reserve economic data shows median household income rose approximately 20% from 2013 to 2023, while average new vehicle prices increased over 45% in the same period according to Kelley Blue Book historical data. Real wages adjusted for inflation grew minimally while vehicle costs accelerated. This gap is bridged by extending loan terms and increasing debt burdens. The University of Michigan's Consumer Survey research indicates vehicle affordability measured by median weeks of income needed to purchase the average car worsened significantly over the past decade. Extended financing isn't just a dealer's strategy, it's become the only way many middle-income consumers can access new vehicles at current price points. Automotive news analysis shows the fastest loan growth occurred in the $50,000 plus segment, with substantial increases in $70,000 to $100,000 financed vehicles. Features once exclusive to luxury brands, leather, advanced safety systems, premium audio, became standard on mass-market vehicles, driving price increases. The average truck or SUV transaction price exceeded $50,000 in 2023 per J.D. Power data. Consumers who previously bought $30,000 sedans now finance $55,000 SUVs over 84 months to achieve similar monthly payments. This normalization of luxury pricing, enabled by extended terms, dramatically increased total debt loads without corresponding increases in actual vehicle utility or longevity. When borrowers default, the losses are concentrated and severe. The Federal Reserve Bank of New York reported auto loan delinquencies reached 8 million accounts in Q4 2023. Repossession typically occurs after 60 to 90 days of non-payment according to industry practice. At repossession, the vehicle is auctioned. Manheim auction data shows repossessed vehicles sell for 20 to 30% below retail value on average. The borrower remains liable for the deficiency, the difference between auction proceeds and loan balance. A borrower who paid $15,000 over 3 years can lose the vehicle, still owe $8,000 to $12,000 in deficiency, and have destroyed credit. They paid heavily and own nothing. Access to reasonable rates depends entirely on credit scores. FICO data analyzed by Experian shows borrowers with scores above 720 averaged 5.8% rates in 2023, while those below 580 faced rates exceeding 14%. A 30-year-old with limited credit history might pay 11% while their colleague with established credit pays 6%. Over 84 months on a $50,000 loan, that 5 percentage point difference equals approximately $12,000 in additional interest. The system penalizes those with less financial history or past difficulties, extracting maximum revenue from the most vulnerable borrowers. It's regressive by design. Those least able to afford high payments pay the highest total costs. For subprime borrowers shut out of traditional financing, Buy Here Pay Here dealerships offer an alternative. The Federal Trade Commission describes these operations as dealers who provide their own financing, often at rates of 18 to 25% or higher. The National Independent Automobile Dealers Association reports the BHPH sector finances over 3 million vehicles annually. These dealers often install GPS tracking and remote kill switches to facilitate repossession. Borrowers pay $400 to $600 monthly for vehicles worth $8,000 to $12,000, with total payments over 3 years reaching $18,000 or more. The effective annual cost approaches 100% or higher according to consumer advocacy groups. It's predatory lending operating within legal frameworks. Not all financing carries high rates. Manufacturers occasionally offer promotional 0% or 1.9% APR financing to move inventory. Edmunds incentive data shows these offers typically require excellent credit and apply to specific models the manufacturer wants to clear. The catch: these promotional rates usually cannot be combined with cash rebates. A buyer might choose between 0% financing on the full price or a $5,000 rebate with standard 6% financing. According to Bankrate's analysis, the rebate plus regular financing often costs less total than 0% on the higher principal, but buyers attracted by the 0% rate frequently choose the higher total cost without realizing it. Even manufacturer subsidies can obscure true expense. Certified pre-owned programs promise lower prices than new vehicles with manufacturer warranties. But Consumer Reports analysis found CPO vehicles often carry premiums of $1,500 to $3,000 over equivalent non-certified used vehicles, while the additional warranty coverage duplicates benefits many buyers could obtain more cheaply through third parties. Financing terms for CPO vehicles mirror new car loans, frequently 72 to 84 months according to Experian data. A 3-year-old CPO vehicle priced at $38,000 financed over 72 months still generates substantial interest and faces continued depreciation. The CPO label creates perceived value that justifies higher prices and extended loans, but the fundamental negative equity dynamics remain largely unchanged. Extended service contracts, often called extended warranties, represent major dealer profit centers. A J.D. Power study cited by Consumer Reports found that fewer than half of buyers who purchased extended warranties ever filed a claim worth more than they paid. The contracts exclude many common repairs, require adherence to strict maintenance schedules, and often contain deductibles of $100 to $200 per visit. A $3,500 service contract financed at 7% over 7 years costs over $4,400 total. Dealers earn commissions of 50% or more on these products according to automotive industry analysts. The buyer finances a product they're statistically unlikely to benefit from, paying thousands in interest on it. Online lenders and credit unions advertise auto loan refinancing, promising to lower rates and payments. LendingTree data shows borrowers with improved credit can reduce rates by 2 to 4 percentage points through refinancing, potentially saving thousands. But refinancing requires the loan balance to be less than or close to the vehicle's value. Lenders won't refinance severely underwater loans. Borrowers most in need of relief due to high initial rates are often those with negative equity who can't qualify for refinancing. Meanwhile, extending the loan term during refinancing lowers payments but increases total interest paid. Some borrowers refinance 84-month loans into new 84-month terms 3 years in, resetting the clock and extending debt to 11 years total. Let's trace the complete financial arc. A buyer finances $60,000 total, vehicle plus roll equity and add-ons, at 7.2% for 84 months, $73,500 in loan payments. Insurance for 7 years at $2,200 annually, $15,400. Registration and fees averaging $300 annually, $2,100. Maintenance and repairs totaling approximately $6,000 over 7 years per AAA estimates. Total, $97,000. After 7 years and $97,000 in payments, the vehicle is worth perhaps $15,000 to $18,000 according to typical depreciation. The buyer spent $97,000 to own an asset worth $18,000, a $79,000 cost to operate a depreciating asset. They paid for the car more than 5 times over compared to its residual value. Beyond the financial mechanics, extended auto debt creates psychological barriers. Research from the Journal of Consumer Research shows consumers in long-term payment plans experience reduced financial flexibility and increased anxiety. Once locked into $700 monthly payments for 84 months, changing jobs, relocating, or handling emergencies becomes more difficult.
The National Foundation for Credit Counseling reports auto loans as a frequent factor in consumer financial distress.
Yet the monthly payment feels unavoidable. Transportation is essential, and exiting the loan early while underwater requires cash most borrowers don't have. The loan becomes a trap, too expensive to keep, too costly to escape, perpetually limiting other financial decisions.
Comparing auto ownership costs to alternatives reveals the scale.
The American Public Transportation Association reports the average annual cost of public transit use at approximately $1,200 in cities with good systems. Ride-sharing for moderate use might run $3,000 to $5,000 annually according to usage studies. A used vehicle purchased cash for $8,000 to $12,000 and maintained over 5 years costs roughly $20,000 to $25,000 total including insurance and maintenance per AAA calculations, far less than the $97,000 7-year financed vehicle scenario. These alternatives aren't viable for everyone, particularly in car-dependent regions, but the comparison highlights how normalized expensive auto debt has become an American consumer culture. Federal Reserve data shows younger borrowers, particularly those under 35, carry higher average auto loan balances and longer terms than previous generations at the same age. Experience generational analysis found millennials and Gen Z average $523 monthly auto payments in 2023 compared to $449 for Gen X. Student loan debt leaves younger borrowers with lower credit scores, pushing them toward subprime rates.
The New York Fed reports auto debt among under 30 borrowers increased 35% from 2019 to 2023.
Early career workers now dedicate a larger share of income to vehicle payments than any previous generation, reducing capacity to save for homes or build wealth through other channels. The auto industry maintains that extended financing provides access and flexibility.
The National Automobile Dealers Association argues that longer terms make vehicles affordable for more consumers and that buyers freely choose their loan parameters. Lenders point to disclosure requirements and state that interest rates reflect credit risk.
Manufacturers note that modern vehicles last longer, frequently over 200,000 miles, justifying longer financing terms.
These arguments contain truth. A well-maintained modern vehicle can outlast its loan.
But industry data also shows the median ownership period is 6 years, meaning most buyers never finish their 84-month loans. The access argument enables a system where affordability means perpetual debt, not ownership. The National Financial Educators Council found that only 37% of Americans could correctly calculate total interest on a multi-year loan in a 2023 survey. The FINRA Investor Education Foundation reported that fewer than half of respondents understood how loan amortization works, that early payments go predominantly to interest. This knowledge gap leaves consumers vulnerable in dealership finance offices where complex calculations happen quickly. A buyer who doesn't grasp that a $50,000 loan at 7% for 84 months costs $63,500 total can't make informed decisions. Industry complexity, APR versus interest rate, finance charges, dealer fees overwhelms consumers who lack financial training, enabling profitable but expensive lending structures. Consumer advocates recommend specific strategies: maximize down payment to reduce financed amount, choose the shortest affordable loan term, shop rates independently through credit unions before visiting dealers, avoid rolling negative equity, and decline most add-on products. The Consumer Financial Protection Bureau suggests getting pre-approved financing to establish a baseline. Consumer Reports recommends buying slightly used vehicles to avoid first-year depreciation. But these strategies require cash reserves, financial knowledge, and discipline that many consumers lack. Systemic reform would require regulatory limits on loan terms, mandatory clearer disclosures, restrictions on negative equity rollovers, or caps on add-on pricing, changes the industry has successfully resisted for decades. Some analysts predict rising delinquencies and losses could force lender behavior changes.
Moody's Analytics noted in 2023 that auto loan performance deterioration might tighten underwriting standards.
But previous cycles show the industry responds to losses by raising rates on remaining borrowers, not by shortening terms or reducing loan amounts. After the 2008 financial crisis, auto lending actually became more aggressive as lenders sought yield. Unless regulatory intervention occurs or a major lender collapse creates systemic risk, market forces alone appear unlikely to reform the structural issues. The current model is too profitable for too many participants to change voluntarily, even as consumer debt burdens reach historic levels. We set out to understand how Americans can spend $100,000 on cars they don't own. The evidence shows a system where 84-month loans at 7+% rates generate massive interest, where negative equity gets rolled forward indefinitely, where dealer add-ons financed over years cost double their sticker price, where insurance costs exceed $15,000 over the loan term, and where depreciation outpaces loan paydown by design. After following every dollar, the conclusion is clear: modern auto financing is structured to maximize revenue extraction while minimizing equity building. A consumer can pay faithfully for years, follow every rule, and still owe more than their vehicle is worth. They're not buying cars, they're renting them from lenders at the highest possible cost. The investigation reveals the mechanics, but larger questions persist. Can a consumer economy sustain ever-increasing debt loads on depreciating assets? Will younger generations accept perpetual car payments as normal, or demand alternatives? What happens when electric vehicle depreciation proves more severe than anticipated, creating negative equity crises for early adopters? How will autonomous vehicles or mobility-as-a-service models reshape ownership economics? Will regulatory intervention eventually cap loan terms or restrict predatory add-ons? These questions lack clear answers. What's certain is that the current trajectory, longer loans, higher prices, more debt, is unsustainable. Something will have to change. The only question is when, and what will force it.